Hello and welcome to this session on money market instruments. In this session, you will learn about the instruments of money market, which include Treasury Bills, commercial papers, certificates of deposit, repurchase agreements, call on notice, and money market mutual funds. Let us begin with Treasury Bills or T-bills. Treasury bills or T-bills for short are a short-term debt obligation backed by the government. T-bills are sold in denomination of $1,000 to $1 million USD. They have a maturity of less than 1 year and they have 3 different maturity periods ranging from 1 month, that is 4 weeks, or 3 months, that is 13 weeks, or 6 months, that is 26 weeks. In India, the minimum investment amount is Rs 25,000 with multiples of Rs 25,000. So what is the process of issuing T-bills? T-bills are issued through a competitive bidding process at a discount from par. This means rather than paying fixed interest payments like conventional bond, the difference between the purchase and the redemption price is the return to the holder. Let us look at T-bills in the primary market. For example, let's say you buy a T-bill priced at $9,800 with a 13-week maturity period. Essentially, the US government agrees to pay $10,000 back in 3 months. So your return will be $200 for a period of 13 weeks. The securities are issued by a regularly scheduled auction process. Upon the Treasury's announcement of the size of an upcoming auction, tenders or sealed bids will be solicited. The bidders then submit 2 types of bids, which are competitive and non-competitive. Coming on to the bidding process. Let us assume that the Federal Reserve wants to issue T-bills worth $4 million. Each bid is for a minimum one of the T-bill. The cap is $1 million and the floor is $985,000. All competitive tenders are ranked in order of the bid yield. The lowest competitive bid is accepted first. As a result, the highest bid prices are not accepted until the issue is sold out fully. Moving on to the secondary market for T-bills. The Treasury securities are an active and liquid instrument in the secondary market. The most actively traded issues, which are usually the ones sold through the most recent auction, are called on the run issues. They have narrower bid-ask spreads than older off-the-run issues. Financial institutions assume the role of brokers and dealers. So what is the price of a Treasury bill? The price of a Treasury bill is the price that an investor will pay for a Treasury security of a particular maturity, depending upon the investor's required return on it. Let us now understand how is the price of a T-bill determined. The price is determined by the present value of future cash flows to be received. Since the Treasury bill does not generate interest payments, the value of Treasury bill is the present value of the par value. So, should you invest in T-bills? Like any investment option, you must first weigh the pros and cons. Starting with the advantages, T-bills are considered extremely safe and are highly liquid investments. They are ideal for short-term investments, are also for fund management. T-bills also provide a hedging facility. On the other hand, T-bills give poor yield in compared to other instruments. They lack the presence of competitive bids as well as active trading. Generally, the investors hold T-bills till maturity and do not come for circulation. Hence, active trading in T-bills is adversely affected. Let us take a look at next money market instrument, that is commercial papers. A commercial paper is an unsecured promissory notes issued at a discount and redeemed at par. A commercial paper is most prevalent form of security in the money market. Let us look at some of the characteristics of commercial papers. Commercial papers are short-term in nature and have maturity period of 1 year or less. They are issued by financial companies, banks, corporations with excellent credit ratings Commercial papers may also include foreign corporation and sovereign issuers. Since commercial paper is usually sold in round lot of $100,000, the main buyers of commercial paper are mutual funds, banks, insurance companies, and pension funds. Commercial papers are issued at a discount. The yield on commercial papers are slightly higher than that of a treasury bill. Moving on to the sale of commercial papers. Financial corporations sell two-thirds of total commercial papers and sell their issues directly to the public. Corporations that borrow less frequently sell their commercial paper called industrial paper to paper dealers who then sell them at a markup to other investors. Most commercial papers are sold in round lots of $100,000, while there are some paper available in $25,000 lots. Let us look at the purpose of issuing commercial papers. Interest paid out on commercial paper turn out to be lower than what you would pay by borrowing from banks at prime rate of interest. These commercial papers are used for multiple purposes. They help corporations bridge their short-term capital deficits. Commercial papers are also used for bridge financing. They are also used to finance the purchase of mortgage-backed securities or MBS to profit from the difference between the higher yield of MBS securities and the lower yield on commercial papers. Please note, in general, only corporations with highest credit rating can issue commercial papers generally. Commercial papers generally have maturity of about 7 to 45 days. Most commercial papers are less than 90 days. Some commercial papers have a maturity of up to 270 days. The 270-day limit is dictated by the need to register the security with the Securities and Exchange Commission or SEC if maturity is longer. This greatly increases the expense and time to issue commercial papers. Therefore, commercial papers will rarely have terms longer than 270-day limit. Why do investors choose to invest in commercial papers? Firstly, we begin with the advantages of commercial papers. A commercial paper is a quick and cost-effective way of raising working capital. It is the best way for a company to take the advantage of short-term interest fluctuations in the market. It also provides the exit option to the investors to quit the investment. Commercial papers are cheaper than a bank loan. As commercial papers are required to be rated, a good rating reduces the cost of capital for the company. It has a wide range of maturities. It is exempted from federal SEC and state securities registration requirements. Now, we look at the risk associated with commercial papers. It is available only to a few selected blue chip and profitable companies. By issuing commercial papers, the credit available from the banks may get reduced. The reason behind the same is due to the cost of borrowing working capital through commercial paper transaction is now relatively lower for the corporate companies in India. In comparison to the cost of borrowing the same working capital through cash credit facility from the commercial banks. The obvious result is an absolute growth of commercial paper market in India, particularly 2007 to 2008 onwards. The issuance of commercial paper is very closely regulated by the RBI guidelines. Moving on to the certificates of deposits, also known as CDs. Certificate of deposits are interest-bearing receipts on deposit made with a bank issued and in a demat form. They are certificates issued by a federally chartered bank against deposited funds that earn a specified return for being a definite period of time. They are one of several types of interest-bearing time deposits offered by banks. Let us take a closer look at certificates of deposit. Certificate of deposits are discounted instrument and are issued at discounted price and redeemed at par value. They are negotiable instruments that can be sold before maturity. They are typically issued with a face value of 100,000 USD In India, it is issued for a minimum of rupees 1 lakh and in multiples of rupees 1 lakh. Large denomination CDs of $100,000 or more are generally negotiable and pay higher interest rate than smaller denominations. Certificates of deposits are issued for not less than 7 days and not more than 1 year. Generally, they are rated by credit rating agencies like CARE, ICRA, CRISIL and Fitch. Since we have learned about certificate of deposit and terms deposit, let us now compare them. Certificates of deposit are negotiable while term deposits are non-negotiable. Certificate of deposits are short-term instruments with maturity up to 1 year. On the other hand, term deposits have maturity of more than 1 year. They can easily be liquidated before maturity, unlike term deposits, which are less liquid. Certificates of deposits are traded in secondary market, but term deposits are not. Certificates of deposit offer lower yields as compared to term deposits. Considering a CD as a savings option, as with any financial decision, you should weigh the pros and cons of certificates of deposit before you open an account. Let's look at pros first. First comes safety. Certificates of deposit from federally insured banks are backed by the full faith and credit of the US government up to $250,000. It amounts to bank subsidized investment insurance and is a major benefit to CD investors. Secondly, it gives better return than saving deposit. Because CD account holders cannot take their money back at moment's notice like saving account holders can, CDs are more valuable to banks than saving deposits. Banks accordingly pay CD investors a premium for locking their money up in the form of higher yields. Thirdly, you get a wider range of selection. CDs are generally available in an assortment of maturities and terms from thousands of different banks and credit unions. This diverse set of options helps investors find a CD that fits their needs. Lastly, fixed predictable return. Unlike savings deposits, savers can count on CDs to deliver a specific yield at specific time. Even if interest rate falls swiftly in broader economy, your rate will remain constant for the term of traditional CD. Now let us look at cons. First disadvantage of a CD is limited liquidity. One of CD's major drawback is that owners can't easily access their money if an unanticipated need arises. Usually they'll have to pay a penalty which can come in form of lost interest or even a principal penalty. One way CD investors can increase their flexibility is to create a CD ladder composed of CDs of different maturities, so portions of your CD saving will be available at regular intervals. And last is inflation risk. CD rates tend to lag against rising inflation on the way up and drop faster than inflation on the way down. Because of that, investing in CDs carries the danger that your money will lose its purchasing power over time and your interest gains are overtaken by inflation. Now let us move on to repurchase agreement, which is also known as repo. A repurchase agreement is an agreement to buy any securities from a seller within the understanding that they will be repurchased at a specified date and price in the future. There are treasury securities that are purchased from a dealer with the agreement that they will be sold back at a future date for higher price. These agreements are most liquid of all money market investments with maturity ranging from 24 hours to several months. A repo is similar to a secured loan. For example, Company A needs to place an order for 10 tractor parts. Company A has no cash to purchase these parts, but it knows that an invoice of 10 recently sold tractors will be paid tomorrow. This means a Company A needs a cash today, but it will be able to pay the debt tomorrow. Instead of going for a long-term financing arrangement with interest, Company A decides it can sell a small portion of its stock and rebuy it tomorrow. Company A is risking the fact that the stock may go up by tomorrow. However, it determines obtaining the financing today is worth the risk. Repo transactions have two legs. First is the cash to borrow against collateral. Second is When the repo transaction takes place, securities are repurchased by repaying the repo loan plus interest. Repo is fully collateralized loan in which the collateral consists of marketable securities. In return, the repo will receive cash from the counterparty. For the party selling the security and agreeing to repurchase it in future, the transaction is a repo. For party on the other hand of the transaction, that is the party buying the security and agreeing to sell the in future, is a reverse repurchase agreement. The reverse repurchase agreement or reverse repo is an agreement to buy securities with the agreement that they will be resold at some specified date and price in the future. On the return leg, the repo party will repurchase the securities and pay the money back to the counterparty. The higher amount takes into consideration the interest paid by borrower to the lender on repo rate. On default, the lender has a claim on the securities. In a repo, the seller is the equivalent of the borrower and the buyer is equivalent of a lender. The repurchase price is higher than initial sale price and the difference in price constitutes the return to the lender. Coming to the defining characteristics of repo, depending on tenure, there are two types of repo agreements. Open repo is a repo agreement with no set maturity date but renewed each day upon agreement of both counterparties. Term repo is repo with a maturity of more than 1 day. The participants in repo transaction are banks, central banks, and non-financial institutions. There is no secondary market for repos. Transaction in repo can amount up to 10 million USD. Maturity of these can range from 1 to 15 days or for 1 or 3 or 6 months. Repos perform 4 basic functions which are fundamental to efficient working of many other financial markets. A party can invest cash and earn interest against the security of the asset provided as collateral, making this a safe investment. The counterparty can borrow cash in order to finance a long position in the same asset, in amounts and at prices that reflect the security provided to the lender, making this a cheap borrowing. A party can earn returns by lending out an asset that is in demand in the market in exchange for cheap cash which can be used for funding or reinvested for profit which can be shortly called as reinvestment. The counterparty can borrow an asset in order to cover a short position. Short selling is fairly simple concept. You borrow a stock, sell the stock and then buy the stock back to return it to the lender. Short sellers make money by betting that the stock they will sell will drop in price. If the stock drops, the short seller buys it back at a lower price and returns it to the lender. This is also known as asset borrowing. Now let us look at difference between reverse repo and repo. In a reverse repo, the buyer of the security has the right to surrender the security at a further date, while in repo, the seller of the security has the right to repurchase the security at a future date. The receiver of funds is the lender in reverse repo, while the receiver of funds is the borrower in repo. Repo rate or repurchase rate is the rate at which RBI lends to banks for short periods. If the RBI wants to make it more expensive for banks to borrow money, it will increase the repo rate. Similarly, if it wants to make it cheaper for banks for borrow money, it can reduce the repo rate. Reverse repo rate is rate of interest at which RBI borrows funds from other banks in short term. It is generally held that the change in the repo rate has its great impact on inflation. The table shown on screen explicitly explains the relation between repo rate, reverse repo rate and inflation. Repos are widely used by managers of money market funds because they generally offer 3 distinct benefits. First is liquidity. Repos provide ability to invest cash overnight, making them a critical component in effort to manage liquidity. The size of the market and supply of repos provide for strong liquidity. Secondly, we have yield advantage. Repos generally provide additional yield as compared to traditional money market instruments such as Treasury Bills, time deposit, agency discount notes. The yield advantage depends on such factors such as repo maturity date, and credit quality of repo's collateral. And lastly, flexibility. The principal amount of repos can be adjusted up or down as fund cash flows dictate, and transactions can be conducted late in the day. Let us look at the other side of the coin, that is the disadvantage. First is risk. There is only a risk if counterparty is unable to repay the loan and market value of the bonds is lower at maturity than when the agreement was entered. Some of the characteristics of bonds such as coupon rate and early redemption may pose a problem in connection with repos and reverse repo. Hence, the investor may face challenges with regard to accounting, tax payment and risk management if he uses repos and reverse repos. Let us move on to call notice money market. Let us move on to call or notice money market. The call money market is an integral part of Indian money market where the day-to-day surplus fund, mostly banks, are traded. Unlike a term loan which has a set maturity and payment schedule, call money does not have to follow a fixed schedule. Brokerages use call money as short-term source for funding to cover margin accounts or purchase of securities. The funds can be obtained quickly. Brokerages know that they are taking on risk by using funds can be called at any time, so they typically use call money for transactions that will be resolved quickly. The loans of short-term duration. The money that is lent for one day in this market is known as the call money. And if it exceeds more than one day but less than 15 days, it is known as to notice money. The money that is lent for more than 14 days is referred to term money. What is call money? Call money is a method by which banks lend to each other to be able to maintain a cash reserve ratio. The interest rate paid on call money is known as call rate. It is a highly volatile rate that varies from day to day and sometimes even from hour to hour. There is an inverse relationship between call rates and other short-term money market instruments such as certificates of deposit and commercial papers. A rise in call money rates make other sources of finance such as commercial paper and certificates of deposit cheaper in comparison to the banks and tend to raise funds from these sources. Banks borrow from call money market for several reasons. One is to fill the gaps or temporary mismatches in funds, to meet CRR and SLR mandatory requirements as stipulated by central bank. And last is to meet sudden demand for funds arising out of large outflows. Moving on to the participants in the call money market. The participants in this market can be classified into two categories. Those permitted to act as both lenders and borrowers of call loans, and those permitted to act only as lenders in market. The first category include all commercial banks, cooperative banks, DFHI, that is Discount and Finance House of India, and STCI, that is Securities Trading Corporation of India Limited. In India, commercial banks play a dominant role in the call loan market. They used borrow and lend among themselves, and such loans are called as interbank loans. They are very popular in India. The second category lenders include LIC, UTI, GIC, IRBI, NABARD, and specified mutual funds. They can only lend but cannot borrow in the call market. A critical component of call money market is the call money interest rate. The interest rate paid on call money loan, also known as the call rate, is highly volatile. It is most sensitive section of the money market, and the changes in the demand and for supply of call loans are promptly reflected in call rates. There are now two call rates in India. One is the interbank call rate and second is lending rate of DFHI Discount and Finance House of India. Let us look at advantages of call money market. First is high liquidity. Money lent in a call market can be called back by any time when needed, so it is highly liquid. It enables commercial bank to meet large and sudden payments and remittances by making a call on the market. Secondly, we have High profitability. Banks can earn high profits by lending their surplus fund to the call market when call rates are highly volatile. It offers a profitable parking place for employing the surplus funds of banks temporarily. And lastly, maintenance of SLR. The call market enables commercial banks to their minimum statutory reserve requirements. Generally, banks borrow on large scale every reporting Friday to meet their SLR requirements. In absence of call market, banks have to maintain idle cash to meet their reserve requirements, which will impact their profitability. The call money market has also its share of risk. The first disadvantage is uneven development. The call market in India is confined only big industrial and commercial centers like Mumbai, Kolkata, Chennai, Delhi, Bangalore and Ahmedabad. Generally, call markets are associated with stock exchanges, hence the market is not evenly developed. A lack of integration. The call market Next we have is a lack of integration. The call markets in different centers are not fully integrated. Besides, a large number of local call markets exist without any integration. Lastly, we have volatility in money rates. Next we have volatility in call and lastly we have volatility in call money rates. Call rates vary to a greater extent in different centers in different seasons on different days within a fortnight. The rates may vary between 12% to 85%. Lastly, let us understand money market funds. Money market fund is an investment whose objective is to earn interest for shareholders while maintaining a net asset value, that is NAV, of $1 per share. The money market fund portfolio comprises of short-term, that is less than 1 year securities representing high quality liquid debt and monetary instruments. Investors can purchase shares of money market funds through mutual funds, brokerage firms and banks. Money market mutual funds are for those investors who want to invest in the money market. These funds are suitable for investors who are seeking returns and whose current income is consistent with preservation of capital over short-term investment in short-term money market securities. It is an option for investors to purchase a pool of securities that are generally provided higher returns than interest-bearing bank accounts. Moving on to the role of money market mutual fund. There are 3 instances when money market mutual funds, because of their liquidity, are particularly suitable investments. Money market mutual funds offer a convenient parking place for cash reserves when an investor is quite not ready to make an investment or is anticipating a near-term cash outlay for non-investment purpose. Money market mutual funds offer the ultimate safety and liquidity. This means that investors will have an expected sum of cash at the very moment that they need it. An investor holding a basket of mutual funds from single fund company may occasionally want to transfer assets from one fund to another. If, however, the investor wants to sell a fund before deciding the another fund to purchase, a money market mutual fund offer by the same company may be a good place to park the proceeds of the same. Then, at appropriate time, the investors may exchange his or her money market mutual fund holdings for shares of other funds in the fund family. To benefit their clients, brokerage firms regularly use money market funds to provide cash management services. Putting a client's dormant cash into money market mutual funds will earn a client an extra percentage point in annual returns above those earned by other possible investments. Money market funds offer several advantages that make them attractive for use as a cash account vehicle. Unlike other types of mutual funds, they are completely liquid and investors can draw cash anytime in the same manner as they can with any type of demand deposit account using checks or debit cards. Money market funds are also typically pay slightly higher interest rate than traditional savings and checking accounts. Tax-free money market funds can also offer an additional boost for those in high income tax bracket who want to avoid generating further taxable income. There are also typical few or no fee sales charges associated with these funds. Let us look at the other side. The biggest drawback that money market mutual fund pose is simply that they offer very low returns compared to equities or other asset classes over time. Investors who keep cash in these funds for long periods of time risk missing out on more profitable rates of return elsewhere, and the returns they will earn on money market mutual funds will seldom outpace inflation. Some money market funds also require some sort of minimum deposit such as $500 or $1,000, and while there is no transaction cost associated with money market funds, they do have expense ratios like any other fund, although they are usually very low, somewhere below 0.5% in most cases. With this, we reach at the end of session. We hope you have understood money market instrument, their features and their pros and cons with this session. Thank you and goodbye.